All righty. Good afternoon, everybody. Welcome to the webinar for today. Glad you are here. Hopefully you guys can hear me okay. I know there was a few people said there were some intermittent sound problems. I heard that too, but it seems like it's okay now. All right. Well, welcome everybody. Beautiful day here in Chicago. And today's webinar will be managing a complete options portfolio for the rest of the year. As we look at the last quarter of the year, you kind of evaluate how are you doing? Are you making money? You're not making money? Obviously, markets had some volatile parts this year, some channeling parts. So what I thought would be good, I haven't done a portfolio class in a while. I'm going to do a class managing a complete options portfolio for the rest of 2019. So it combines some different strategies, longer duration, shorter duration. Basically, we're going to trade like we trade, what the market's telling us to do, and kind of guide you through that process. I think this is going to be a unique class, not just because of the topic, and today's for educational purposes only, but it's going to be different because I made it 6 weeks instead of 3. And the reason I did that is to get more practice, and I want to get you guys kind of a lot of practice, a good foundation for doing this the rest of the year. And I just didn't think 3 weeks would be enough time. So I don't normally do 6-week classes, so I think this is a good opportunity to get a lot more practice in how to do this. And 6 weeks of how to do something is better than 3 weeks. And so I'm excited about that. It'll be 12 class dates. The information, as you see up here, the first class, it starts Tuesday, September 24th, and it'll go through Halloween. We'll end on Halloween, October 31st, 6 weeks. Class days will be Tuesday and Thursday. Class times will be 1 p.m. Central, minimum 1 hour. And I usually go over. So you have 12 sessions and very reasonable cost, $497. Usually our 3-week class is $297. And so, and we've always had it that way, never really increased it for a 3-week class. And so basically we doubled that, took 15% off. A very good price for what you're getting. It's a great price. But it's a good price. It'll be a 6-week class. And again, I would definitely encourage you to take the opportunity for that because they have 6 weeks to really show you how to do something. I think it's rare with us. All classes will be recorded and archived. You can submit questions anytime. So it doesn't matter whether you're there or not. You'll be able to, when you do see it, ask questions. There'll be live trades to show you how to do it. Every session that I'm teaching will be live trades, and I'll do most of the sessions. Mark Fenton and Jay Bailey, who work with me, will do at least a session each, and they're excellent teachers. As we're talking about this, just to give you an overview today of a complete portfolio, what does that mean? When we're making decisions, where does all the strategies that you guys do, where does it fit in? You guys are seeing my slide, right? You guys are seeing my slide? Okay, thank you. So in a long portfolio, that's the view of an investor that you like a stock or the market over time, right? And, you might say, I like Apple or I like SPX over time. It's an investor approach. And so those are more neutral to bullish strategies, long stock or mutual fund or long an ETF, covered right, cash secured put. long diagonals, put credit spreads, some broken wing or ratio butterflies that basically have no risk or just profit on the upside, long leaps, collars, synthetic long stock, buying out of the money call, selling out of the money put type thing. But these are all, this is an intentional part of your portfolio. And on a 100K portfolio, and we might put, because we're getting near all-time highs again, we back off of this a bit. You know, it might be 30% on a hypothetical 100K portfolio, whereas in December and January, when the SPX was in the midst of a correction, we were probably 60%. So that's where these strategies would fit in, and it's intentional. Again, it's not based on when I wake up in my pajamas and what do I think the market's going to do. It's in a long-term approach like you have in your retirement account. And so these are intentional trades I'm putting on every month. The income portfolio is based on range-bound strategies based on probabilities and time decay. And, you know, we have indicators, which we'll talk a lot more in the class touch on today, but when we put this stuff on. And I'll talk a little bit about that. And this would be your calendars, double diagonals, iron condors, butterflies. Even though the long portfolio is monthly income, the perspective is different. Long portfolio are neutral to bullish strategies that I'm going to put on every week, every 2 weeks for the next 10 years. Income portfolio is more range-bound trades and based on some considerations, which I'll mention in a few minutes, and some indicators, and we'll put these on every week or every 2 weeks or every month, and these are range-bound strategies. And then the speculative portfolio, that's where you wake up in the morning. How many of you are like this? And this is where I think a lot of the options industry is. Speculative portfolio, you wake up in the morning and you have what? And you wake up with an what? What's the word? It begins with an O. What do you wake up with when you're in your pajamas? An opinion. So the speculative portfolio is somebody saying, based on technicals, fundamentals, a bad pizza, whatever, I think this stock or the market is going a particular direction. And these are some strategies we use, back spreads, which are ratio spreads like buy two, sell one, directional credit spreads. In the long portfolio, we have put credit spreads, that's neutral to bullish. Speculative portfolio use of credit spreads would be, you know, when you're near resistance, call credit spreads, near support, put credit spreads, whereas long portfolios an intentional put credit spreads constantly. So speculative portfolio, back spreads, ratio spreads, credit spreads, both ways, directional calendars and butterflies, anything around earnings, because that's speculative, earnings plays, long calls or puts, long verticals. So you have this. So that's what we're going to be doing over the next 6 weeks is based on these 6 considerations, that's what's going to help us make a decision. 7, really. I mean, price of the underlying, whether it's a stock or the index. What is the implied volatility? What has the implied volatility been over the last 12 months? What's the average true range? That's the distance between the high and the low, right? That'll tell you, are we moving a lot or not? You know, in July, when the market wasn't moving much, or in June, this range between the high and the low in SPX might have been 35 points average in a day. But as it picked up in August, right, as you see, and we'll show a price chart in a second, as you have bigger ranges, the high and the low range of SPX in a given day probably jumped up to 70, and that's tougher to manage range-bound trades when that picks up. Standard deviations is another thing we look at. Is this a bigger move than expected? Historical volatility is like statistical volatility. It's the volatility of the underlying. We look at moving averages, speed of the market, and other indicators. But these things will determine in a lot with our allocations in the long portfolio, income portfolio, and speculative portfolio, and also the different strategies we put on and the different adjustments, right? So we don't just blindly put this stuff on. Liquid vehicles, I think that's key. We need to be able to get in and out of this stuff, right? So we use a lot of SPX and RUT, but you could also use SPY, IWM, liquid ETFs. If you're going to deal with stocks, not that you can't use stocks under 100, but generally I'm looking at stocks over 100 if you're looking for some premium in them to sell, to do a lot of these strategies. And this is just a few pictures I took today. We're pretty close to this. I looked at this when SPX was 29.87. Right now, as we speak, it's a little bit higher, 29.92. And we're only about, what, 23, if the high in the history of civilization towards the end of July was 30.27 in the SPX. We're about 35 points off the high. So we're in the upper end of the range. The VIX levels are, I put 15. As we speak now, they're about 14.85. So ATR is much lower than it was. It's at about 31. And historical or statistical volatility is 18. And as you look here, we've kind of come out of this, as you look at a price chart here, towards the end of July. You know, if you look at most of July and June, you're kind of range bound there, and then market started heading down. In the last 5 or 6 weeks until last Thursday, yeah, it is correct. ATR is 31, correct. The last 5 or 6 weeks till last Thursday, we were in a very volatile range, but a very defined range. And the range was basically 29.25 on the downside, and the 200-day moving average was about 2,900. And on the upside, oh, I said it wrong. Excuse me. 28.25 during most of this little period here, up until last Thursday, we were between 28.25 and the 200-day moving average was about 2,800. On the upside, we were about 29.45, and which was right around the resistance there, the 50-day moving average. And you could see, I mean, we were there, we went down there, up, down, up, down, up. I mean, we were zigzagging in there. But as you see there, during that period, it was very volatile, big candles. And so it was very difficult trading shorter-term trades in that period. Agree? And so we look at a lot of these things to determine what strategies, and because of the indicators, right at the beginning when it started, candles were pretty big there. We're basically doing, for most of the last 5 weeks, trading longer duration iron condors with the volatility extended. VIX was over 20 or 21 most of the time, doing longer term 50 days out type butterflies and iron condors, and that worked really well. Last Thursday, we finally broke out of the upper end of the range, that 29.50 area, and volatility started coming down. So right now, we're above that. And this could be, and so right now, we're above the 50. We're kind of moving out of this 5-6 week range since last Thursday. And the vols, that's why we're in the 14s, right? So we're in a lower vol environment right now. and we're staying above the 50-day. So the wind has changed a bit, right? As far as the ATR that we use on Thinkorswim, it's an 8-day. 8-day is about 31. And again, it's come down dramatically, right? So the range between the high and the low of SPX during the day is tightened up a lot. And so we're looking more at short-term trades with duration of 7 to 15 days at this point. And if you have any questions, feel free to, again, put them in there. All right. So a couple things I would look at in today's environment. John says the sound is really stopping and starting a lot, happening for, oh, that was earlier. Okay. You guys can hear me okay? Jerry says, when writing options, do you focus on weekly options? When I'm selling options, the question is, do I focus on weekly options? Now, again, just to define here so we're all on the same page, can you do weekly options 7 days out, and can you do weekly options 50 days out? Yes or no? Can you do weekly options 7 days out, and can you do weekly options 50 days out? So weekly options don't signify if it's a shorter term duration or not, do they? So if you mean weekly options that are maybe 7 to 15 days versus weekly options or monthly options 30 to 60 days, we write in terms of the duration. A lot of it is based on what's going on in the market, particularly the VIX levels, how fast the market's moving. Like I said, if ATR starts kicking up a lot, we back off of short-term trades, which we do, which we have, which we back off of. So if you look at the last, except for last Thursday, most of the last 6 weeks, where were we writing or selling options in? 45 to 50-day durations. Before that, when the ATR was lower and VIX was lower, what were we doing? A lot of short-term and longer-term. So, in other words, we don't blindly just sell short-term options or blindly sell longer duration options. We let the market, in terms of volatility levels, the speed of the market, some of the considerations I said, determine that. And so that's what we're going to be doing during class is whatever the market throws at us over the next 6 weeks, we'll show you how we're making decisions, what strategies we do, what durations we do, what adjustments we do. Yeah, it's just, you know, again, what you'll learn in the next 6 weeks is no different than, you know, Jerry, if you went with somebody in a sailboat and said, Jerry, we're gonna go in a sailboat, and I don't know anything about this, from Chicago to Bahamas or whatever, or wherever we're going to go. Well, you're going to have different weather conditions. You know, you say, well, how are you going to drive the sailboat the whole time? Well, depends on the weather, right? Same with a pilot. If he has bad turbulence, he'll maybe go around it. So I don't think it's a good plan to just say, I'm going to sell 1 day options. I'm going to sell 7 day options. Well, are you going to sell 7 day options if there's a hurricane in your front neighborhood? I don't think so. So that's what we're trying to show you is how to do this a very reasonable way, right? All right. So here's a couple examples of trades that I'm looking at today based on the weather conditions in the market. And VIX, VIX is 1487 right now. And we haven't been in the 14s in VIX in about 5-6 weeks, right? So since we broke over the 50-day moving average around that 29.45, 29.50 level last Thursday, the vols have come a tumbling down, right? A tumbling down. So here's a type of a trade that I would be considering. Would be an at-the-money calendar. And if you look at this, there's a 16-day calendar. And again, I took this slide when we were a little lower, 5 points lower. We're at 29.87, and there is no 29.87 strike. So what did I do? So I'm selling the SEP 27, 29.90, 16 days from expiration, and I'm buying my long, in this case, OC4, 23 days from expiration, doing it at the money. And generally with a calendar, if it's between a strike like here, this where 29.87, I'll go to the strike up because that will give me just a tinge long delta. You can see the position delta is close to 1 delta long. And you usually want to be that when it's a long volatility trade. Generally, volatilities will decrease as we go up. The cost of this trade is $6.80, or margin or risk of 680. These are the Greeks. These are the SPX at the time I was looking at it. VIX level, delta is pretty close to 0. Here's some of your Greeks. It's always positive theta. The way you make money on a calendar, theoretically, if it doesn't move that far away from the short strike, say, how do you make this kind of money on a $680 investment? Well, at expiration, what will, if we close at 29.90 at expiration in 16 days on September 27th, what will that SEP 27 that we sell today go for? What will that be trading with in 16 days if we close exactly at 29.90? Whatever we sell the SEP 27 today, what will that be worth in 16 days if we close at 29.90? The answer is right. Mark's got it, 0. So 0. And in 16 days, OC4 expiration will still have 7 days to go. So will there still be value in the OC4? Will there still be value, 1 week of value in the OC4? Somebody say yes. Humor me. Somebody say yes. Yes, right? There will still be value in the OC4 29.90 on expiration day of the short SEP 27. So what does that mean? Right? Why is this profit? Why does it show $1,000 of profit in 16 days at expiration if we close at 29.90 on only a $680 investment? Well, that's because you hit the bullseye. Now, is that realistic? No. Am I going to hold it till expiration and bet that it closes at 29.90? Of course not, right? But that's how a calendar makes money. As you go near expiration, your shorts will decay a lot quicker than your longs will. Right now, we have a plan. Obviously, we're looking, a lot of times I'm looking to make maybe 10% on this and maybe be in this trade maybe 4 days. So for every one contract, if I'm looking to make 10%, where will I sell out the debit? If I'm looking to make 10%, about where will I sell this out at? If I'm looking to make 10% on my capital, where will I sell this trade out? With my goal being in the next 4 days. What's the answer? If I'm looking to make about 10%, all right, if I pay $680, 10% of my margin is $680, about roughly $700. 10% of 700 is 70. If you add 70 to 680, we'd sell it out at 750 credit, right? And if I don't want to lose more than, let's say, a little bit more, 12% of 700, right? be about $85. So if this 680 debit goes to, let's say, 595 or lower, I'd get out, right? So what's that called? A plan, right? It's kind of the gist of it. But with the VIX low, this is kind of, again, have we been in the 10s, 11, and 12s yet? Yeah, but I think for the market right now, it's not a bad idea to do a calendar. And that would be one of the things we'll be talking about. So another trade would be, and this is just pick a couple trades, a broken wing iron butterfly. And again, I didn't intentionally look out to do this, but with us at 29.88, Dino made a good point on that calendar trade. There's 1 week between my long and my short. And that's one thing we'll show you a lot in the next 6 weeks. What distance should you go between the long and the short? You say, Dan, what's the major reason you showed this type of calendar with 1 week distance between the long and the shorts? Because it's cheaper, right? It's going to be more expensive if you have 2 weeks between the long and the short. More expensive if there's 3 weeks between the long and the short. Just want to give a cheaper example, just see that you can do cheaper examples, and it's still a good calendar. Maybe someone with a smaller account. A broken wing iron butterfly. So an iron butterfly is just, the foundation of an iron butterfly is just selling an at-the-money call and put. That's all it is. The foundation, 4 key income strategies we do, they're all based on the double diagonal, which we're not going to get into today, in the iron condor, kind of 2 cousins, as I would call them. The foundation is selling an out-of-the-money call and put. That's called a short strangle. And we interplay those a lot, right? The double diagonal and the iron condor. Iron condors are more in a higher volatility environment. Double diagonal is a little bit lower volatility environment. But the foundation is you're selling the out-of-the-money call and put, and then we're doing hedges against them, right? In an iron condor, your hedges are in the same expiration. In a double diagonal, your hedges are in a further out expiration. Calendars and butterflies are kind of cousins. They're going to have this kind of teepee type graph. Calendars would be in a lower volatility environment, butterflies a little bit higher. Because the volatility's come down, I'm doing a little bit longer duration butterfly like we've been doing most of the last 5-6 weeks with VIX most of the time over 20. Now the vols come down, so I wouldn't go as far out, 45 or 50 days. I'd bring my duration in a little bit. And so I sold the original, as I set this up, I sold the 29.90 calls and 29.90 puts. And an iron butterfly and a calendar, you're selling the at-the-money. So the foundation of an iron butterfly is you're selling the at-the-money straddle. So, Dan, why don't you just sell the naked options? I'd never do that. It's too much risk and too much capital. So when I started this out on a 30-day butterfly, I bought my hedge, my long puts, 40 points down for my short put. And I bought my long call originally 40 points up for my short call. So I originally was looking at the 30-30. But when I looked at my position deltas, by being a balanced iron butterfly, balanced just means the distance from my short call to my long call originally was 40 when I looked at this today, and the distance from my long put to my short put is 40. When the width on both sides is the same, you'd call that a balanced normal butterfly, balanced butterfly. But because my position deltas, when I had a balanced butterfly, the 29.90, 30-30, 29.90 put, 29.50, I was 4 deltas short. I wanted to get my position deltas closer to 0. So how did I do that? Instead of buying the 30-30s, I bought the 30/20s. I came a little bit closer to where the price was, and that cut my position deltas down to zero. So my intent was not to do a broken wing butterfly with little or no risk on the upside and more risk on the downside. My intent was to get my position deltas to zero. The result was now I have a trade that doesn't have much risk on the upside. It needs to become ultra popular in the options industry community over the last 7 years, mainly because the market's been going up. But be totally aware that there's risk on the downside. It's like a poodle biting you in the knee on the upside, a pit bull on the downside. So you got to know what you're doing. But this is something. The credit for this is $29, and then to determine your margin, you look at the width on the put side is bigger than the width on the call side. It's 40. So you have $4,000 of risk on this trade minus the credit. So for every one contract, it costs you $1,100 here. And this is your margin. So if I'm looking to make 10%, it's 10% of $1,100. So let's say that's $110. I'd look to buy this thing back at a little bit under $27.90 credit. So if you're looking for an extremely practical class, live trades, and what we're doing, not theory, not just instruction, but very practical. This is a rare opportunity in Sheridan Mentoring that I'm doing something for 6 weeks, and I think you'll get a ton out of it. And very cheap for going with that kind of practical help for 6 weeks, how to do this. And we'll be doing it together. Chris from the famous Gilletto family says, is theta of 4.77 on this trade kind of low? Here's the answer. No. When you look at a 30 to 50 day trade, right, there's a saying in the world, in life, and in options. You can't have your cake and eat it too. So having a theta near 5 is normal for a 30 to 50 day trade. If you're doing a 7 to 15 day trade, the theta bumps up dramatically. So, no, it's just, so a theta of 5, if you do a butterfly or iron condor with a theta of 5, all it signifies is you're doing farther out duration. That's it, right? So it doesn't make it, it's not bad that it's lower theta, right? There's a trade-off, right? You get lower theta, but you have lower short gamma. So that means you have kind of a smoother T plus 0 curve. So as the price goes against you, it's like a warmer blanket in the winter versus if you're doing a 7 day trade, during a lot of the last 6 weeks, the market was moving like a crazy man. And so even though you had a lot of theta, it seemed very low because the price movement was nailing you. So that's, if you look at an short Vega or long Vega trade, 30 to 50 days out, that's pretty normal theta for that. So, folks, that's my 2 cents, kind of warming you up for the, I think, a very exciting 6-week class starting a week from this coming Tuesday. And I think you'll if you commit yourself to it, you'll really learn how to do this. And you get a rare opportunity, I think, to go this long, 6 weeks, and see how to do this. So anyways, if you have any other questions, let me know. I'll hang around here for a minute or two. And then I think there should be sign up on our website sometime in the next week or two. And that's that. So any other questions? If not, I think this video will be available for listening after. And again, as Dino said, theta grows, right? So again, there's always that trade-off. Lower theta, further out duration, but more cushion as the market moves. And in the last 6 weeks, you had a lot of iron condors and butterflies we were doing with the market moving as crazy as it did, even though we were in a range, we were able to get very high volatility, but the price movement didn't really hurt us. I mean, because with the high volatility, we were able to do iron condors 40 days out was over 240 points protection on the downside and about 180 on the upside. So that was a very warm blanket in the winter. Lewis says, would the adjustment be to add another at break-even breach? No, there's different adjustments, Lewis, and we'll go over those. I wouldn't adjust at the break-even on the upside. There's no need to. If you look at the graph on the upside, Lewis, it's like a little poodle biting you in the knee. You're not going to call me up and say, Dan, this poodle is biting me in the knee. Can you call the emergency room? I say, Lewis, come on. It's a stinking poodle, right? On the upside, you have $100 of risk if the SPX goes up 1,000,000 points. So is there panic on the upside at the expiration break even? No. And we'll walk through that. There's about 3 or 4 things you can do on the upside with this, but I think what we'll go over is that it's not cookie cutter like something like this. I'm not going to adjust at the break even. Why? Why should I? Is there a problem? Right? If we go to the break even in 3-4 days, is there a problem on the upside? No. So I think those are good questions, and these are things we'll go over, and we'll put on trades like this. So we'll go through them together, and I will show you how I will be doing them. So we'll be doing live trades, working together through this. All right, folks, have a wonderful evening, and we will see you a week from Tuesday for a 6-week adventure. Have a good day. Thanks.